Hi, I'm Eric Griffin, COO here at ITM Trading, and we wanted to do something a little bit different for our Thursday Flash and Fives with Lynette Zang. So what we thought we would do is take some questions that we get from our YouTube viewers, and I narrowed it down to 3 of them, and then I figured we'll just ask Lynette. She doesn't know what the questions are, and I'm going to ask her, and then we'll just get her real, organic, live answers. So if you have questions, always post them on our YouTube channel, and then we have our team go through them and kind of pick ones that we want to use for the week, and we'll be doing that on Thursdays. So Lynette, I have a username from YouTube, Who Am I?
Okay.
Says, you never say if gold or silver is a better investment. So.
Okay. Well, the reason why I never say that is because I don't think of it in terms of fiat money. I think of it in terms of function. So since the dollar is declining against either one of them, personally, I prefer silver for my barterable position and gold, and some gold for my barterable position, but my gold for more of the growth position. Because frankly, when it goes to fundamental value, unless you have to pay a bill or do something with the dollar, the fiat dollars, you're not going to want to convert it anyway. So that's why I never talk about it in that way, because it's not a trade for me. It's a tool.
Yeah, and that's what I was going to say. It sounds like you're talking about it as though it's a tool, and so it's the right tool for the right job.
Exactly.
Okay.
Exactly.
Okay, so David, I think his last name is Yuri. David Yuri asks, if a market moves down on increasing volume, does that indicate anything?
Absolutely. It indicates that people are getting out. So yes, if a market is moving appropriately, when it's moving down on up volume, now you've got to run. So that's what that means.
Okay. Jesse James, and then Carl, if you would keep me apprised of time, because I have extra questions I could ask too, if we go through them too fast.
Okay.
So Jesse James asks, should we be concerned about any cash we have in money market funds, and in what circumstances?
Well, they've put in all the new money market rules. So that means that anything that was a corporate money market now has fees and gates. So in a run, boom, your money's going to be closed out.
So when you say run, what do you mean? When there's a
well,
run
a
on
lot
the
of
money
people
market
want to
fund?
sell.
Okay,
right,
got it.
Right. Because in the way the system is interconnected, right? If the stock market starts to run, it's going to create a run in all of the different markets, including money markets, where people think it's really liquid. But if you look at what happened to them back in 2008, they froze. So they changed the laws and they put in fees and gates, and what that really did was it shifted a lot of the money that's held in corporate money markets into the government money markets that they don't have the fees and gates in there. So if there is a mass exodus, and a lot of people want to liquidate at the same time, if you are in a corporate money market, then you are either they're going to close it or they're going to charge you a very onerous fee. They actually say that these fees must be large enough to inspire you to stay in the fund. Okay, they want the money in the fund. This is how a lot of corporations used to fund their day-to-day operations.
So there's really an added layer of risk than there was in 2008.
Oh yeah, absolutely. There is.
All right, so we're about 4.
And just a little more on that. We do have a piece, so I'll send the link to Bill, or the image to Bill, that shows you what those parameters are, so you can go in and look. And if that's what you have, you can make some educated choices.
All right, so one more, and I don't have the username for this one. He didn't put it on here. Maybe it's Wade Wheelington II, maybe. Says, why wouldn't the Fed raise interest rates? Why wouldn't they?
Well, I frankly don't see why they wouldn't right now, because their credibility is being sorely tested. I don't think if the reason to raise rates is to slow down an overheating economy. The global economy, the economy in the U.S. is not overheating. So there's actually no real reason to raise the rates, but they need those rates up so they can drop them the next time. So I can't imagine any reason why they won't raise the rates on March 15th, but I don't think they should. Where you hear the hesitancy is, I frankly think it's all kind of garbage anyway.
Well, so it's more about saving face than it is about anything really that's going on in the economy, is what you're saying.
Well, it's about saving face and getting into position so they can drop the rates the next time.
Okay.
Because also by raising the rates, we're going against what the rest of the world is doing.
Yeah, and I was watching a chart. I just saw a chart from ECRI this morning, Economic Cycle Research Institute, that said that the growth trend just turned up, like late last year. So it's not like what you were saying. It was declining for a long time and it just turned up. So it's not overheating by any stretch. It's just getting started.
Well, since you brought that up, a recent, and I'll if you remind me, I'll list this, give this image to Bill as well to post. But JP Morgan Chase did this wonderful PowerPoint. And they actually show what's pushing the market up, and that's inflation. So even though ECRI, saw that trend up, we don't know how much of that is real growth. And well, actually we do. You'll see on this chart, according to JP Morgan Chase, how much of that is inflation and how much of that is actually real growth.
Okay. All right, guys, thanks. So submit your questions on the YouTube, and we'll pick some, and we'll do them every Thursday.
So subscribe to us on YouTube, like us on Facebook, follow us on Twitter, and give us a call, 888-696-4653. Bye.